Welcome to UpThinking Finance, a podcast that offers a unique and discerning view of economics and financial planning. Here is your host, Emerson Fersch.
Welcome to another episode of UpThinking Finance. Arnold Vandenberg once said, "Value investing does not appeal to the masses. If it did, you would never be able to buy a bargain." It's no secret that the financial markets and geopolitical environment we live in right now are about as confusing and literally shifting from one day to the next. And it's very difficult to try to figure out how to navigate a long-term view when so much of the short-term is in turmoil. I mean, inflation continues to go up in spite of what global central banks try to do to control it. Interest rates are at 20 to 30-year highs. You have gold at all-time highs. You've got geopolitical conflict and confusion literally in every corner of the globe. And with that backdrop, most global equity markets continue to go up. And so where do you turn to get some kind of sane, rational analysis or just advice or an opinion? I believe that once you get past all the titles and tiaras of fancy degrees and financial qualifications, and I'm one of those people that has a few letters after the name. I don't know that really matters anymore. What does matter, I think, is experience. And so today's guest is going to bring to us a significant amount of experience. His name is Charles Heenan. He's a co-investment director at Kennox Asset Management based in the UK. He heads the investment team there and has been running the portfolio with his associate Jeff Legg since they launched their firm in July of 2007. Charles has over 3 decades experience in global stock markets and over this time developed a distinct value approach to global investing. Prior to Kennox, Charles was a key member of the highly successful Asia Pacific and emerging markets team investment activities at the global investment firm Stewart Investors. So it's my pleasure to welcome, coming to us from Kennox Financial in Edinburgh, Scotland, my friend Charles Heenan. Charles, welcome to UpThinking Finance.
Emerson, lovely to see you.
Thank you. So I think a good place to start would be when you and your partner Jeff started Kennox, which was in 2007, which in hindsight was kind of an interesting time to start a global equity firm. Maybe talk about that decision, if you don't mind.
Jeff and I decided to kick off in 2007, and the reason. So I've been in the markets for about 15 years at that point, and what really led to Kennox was there's some point you figure out what your natural style is. What works for you? What makes you more confident that you can perform in the longer term? And the penny dropped. I've been in the market for about 15 years. I've been looking at different styles. I've worked in different areas of the markets, different geographies. And I said, actually, this is really what I believe. And if it's really what I believe, then I should back it. And I should go and start my own company. And we can get on to running cultures of companies, but the more you can align the company to the client, the closer it gets. I think, Emerson, this might play to you as a manager of a small business yourself. The small businesses have a real advantage against the big guys. We've got disadvantages as well. But when you can align yourself as closely to the client as possible, get rid of as many distractions, that's what I wanted to do for the rest of my career. So Jeff and I managed to get that off the ground in 2007. You just never know when things are going to come together and work for you. It turned out that we were just kicked off in front of a great the global financial crisis. I mean, what could go wrong? But again, what actually we did absolutely fine in that. We made money in 2000 in the global financial crisis. 2008 and 2009, and that sets you up for a long period of time. Often they say, if you can get through a recession, if you face a tough time in the business early days, it makes a huge difference. So, now, long and the short of it, why do I get into it? Is because this is how I believe people should run money, and I think this is how I should run money. Jeff and I joined together on that, and this is the best vehicle that we have to do it. A boutique company is the best.
It's funny you said about starting off, in a period like that of turmoil, because I was thinking some of the best client relationships I had in terms of just if you're boiling it down to performance were clients that came on at that period of time because it was just up from there, and it's just kind of funny how the timing works sometimes with people. I was going to get to this before, but I'd like to dig into it because I think it's what you said is really valuable about aligning the company values with the clients. And I know on your website, I was drawn to this statement. It says, our Kennox value philosophy drives everything we do, from the structure of our business through our process to the highly differentiated portfolio we produce. I'm just curious, and maybe you already answered it, but if you can elaborate a little bit on how the business structure align, maybe just explain that, because I think that's really important.
I worked for a few years with a guy called Angus Tulloch, and he was an amazing investor, and I saw that style. I'd seen other styles in other businesses I've been in. I worked for a small, when I moved to Scotland, so I was born in Canada, that's my accent, but I moved to Scotland in the late 90s, so a few years ago, and I joined an independent Scottish company, and I liked that. I liked that it was 100 people, everyone who owned the business was in the business. It was all there, and you can know all 100 people. Things changed, and we were purchased by a bank, cultures change. Banks are different places, and so I spent quite a long time thinking about, with Angus and how he was running money, with the corporate culture that we'd set up, and if I was going to do it myself, how exactly would I build that? Put all those pieces together. So without question, what's the stuff that makes a difference to us? Independence makes a huge difference. The three founders own 95% of the business, and still firmly believe, let's all stay aligned and know where we're going. Stay focused. We only do one thing. Listen, we could have started 100 different funds and tried 100 different things, but we just decided this is what we're good at, and let's stick with it. And then align. So all of my equity wealth is in the fund, and we only run one fund. So I'm trying to be as aligned as possible with my clients. So you put those pieces together. Listen, there's a lot of advantages to being in a big company. They've got a big marketing budget. They've got history. People, it's safe, and so on and so forth. But they also can, they can make big mistakes, and there's dangers that you can drift into. So if you can keep a simple business and keep it really tight and not outsource, not make too many of the mistakes, then that can be really powerful. I mean, it's such an opposite example, but everyone knows Warren Buffett. It was just last weekend, it was Berkshire Hathaway, but the amazing thing about Warren Buffett is that even though he's running one of the biggest companies in the world, he's one of the richest men in the world, or was, he's still making the investment decisions, and he's still running the business. And that's what you can retain in a boutique, and that's what's so original about Berkshire Hathaway, with so much respect, and so many people have so much respect. I'm not quite sure why you have so much respect for Berkshire. I'll tell you why. It's because you've been able to keep those communication lines really, really tight. That's what you can do in a boutique business, and that's what that's the side of the culture we're really, really focused on. And so, we just think it gives you a huge advantage. Let the big guys be the big guys. Let them, go crashing down whatever routes they want. To be able to have a really small team, be able to make decisions really effectively and quickly, but also to be completely aware of all the issues. I'll give you one example. Many people nowadays find ESG quite complicated. So you outsource it, and you just say, what's the score? What do the ESG guys say the score is? Absolutely not. We think the fund managers should be making every ESG decision, because it's all part of the whole pie. When you make an investment decision, you're buying the past, the future, all the ESG, all the stakeholders, the valuations, the balance sheet, you're buying it all. You can't just suddenly say, oh, well, we're going to ignore part of it and let someone else make a decision on it. We don't believe that works. So keep it really, really tight. Tie all those pieces together. We think in the boutique business with the fund we run, great outcome.
My business partner and I have gone through kind of this decision. I mean, I've always run a small shop, as an independent guy myself for forever, again, on the retail side of things. And, Amy and I made a decision, basically what you said. We want to be the face to the clients. We don't want to get to a point where we've got, layers and layers. Because, and so it's a conscious decision. And so it's just good to hear you explain it, because you're pretty much affirming everything I've believed, in this business, because, money's personal. It really is for people. And, Anyway, no, I'm glad you elaborated on that because I really was drawn to that, to your website and the way you communicated that. So 30 years running money globally. I mean, just, this would probably be the meat of our discussion, but I really like you to just kind of run through. I mean, that's going back to what, the early mid 90s. I'd love to hear just, how these things have changed, and I've got a couple other questions, but I really like just to see how this has evolved over the years because it's got to be a journey.
A bit like the culture, we could talk for a long time on this, but no, it is astounding. I mean, I was in university in the late '80s, and I remember my flatmate, my housemate, come back with this box about this big, and you'd stick a floppy disk into it, and and you'd type on the black and green writing and so on. There were no computers. When we started in this industry. There were some, but there were not. And one of the early firms I joined, they wrote things on paper. There were paper tickets. This was a research house and a brokerage house, and they wrote paper tickets. Anyways, and one of the first things I did was sit down and actually put it all on a spreadsheet. I sort of honed up a little bit of the spreadsheets. We were a little bit past. Microsoft was onto this, thankfully. But you just can't remember how different it was. Commissions. I mean, the commissions, that were paid back then were astoundingly different. High frequency trading was only the big banks because they're the only ones who could afford to, because otherwise you paid too much in commission. International, I mean, in Canada when I started, the pension plans could only put 20% of their money outside of Canada. 20% of their entire investment could go outside of Canada. It wasn't a capital control, but there was real barriers to this globalization. So it is fascinating to see what has changed there. When I started in the early '90s, Asia was it. I mean, goodness, if you weren't in Asia, you just weren't anywhere. So it's sort of interesting to then go through 97, 98, Thailand went down, and Asia crisis, and Russia goes down, emerging markets. China, 10 years ago, 15 years ago, China was back in. I guess the thing that hasn't changed, so this has all changed enormously. The stuff that hasn't changed, booms and busts are part of financial markets, and so I'm always really worried. What we're interested in is where's the gap? Where can we see the chinks in the armor? Where we think we can make a lot of money that's very different to the rest of the market, especially when the markets get carried away. So I think the point that's what hasn't changed is that there are booms and busts, and that there are huge opportunities, and especially there will be always opportunities away from consensus. That if you can find the right opportunities, you don't have to follow the herd. And for us, that's one of the biggest issues right now. Is talk about some of the things that have changed. I mean, just in the last few years, ESG moved to passive. I mean, in the last 15 and 20 years, a massive move to ESG, the massive move to passive. The massive move to momentum, the FANGs and the Mag 7 tech, all of that has pushed in a certain direction. There's still enormous opportunities in the markets that are different to that, and that's what we think is fascinating.
You and I are kindred spirits because and I think that's just like DNA stuff. Because even when I was young, I was just the guy that would just go the other way. It was just like a natural. I just was drawn to it. And, no, that's really interesting to hear. So, I guess maybe the thing I would ask you would be, I mean, you've got the whole globe and you're coming from, here's a question. So you're coming from the other side of the Atlantic from a different perspective. People here, I'd say if you were to take the average person's portfolio in the U.S., it's probably 80% U.S. stuff and whatever else overseas. How is that a different perspective maybe on your side? I'd love to hear that.
I think there's a couple of massive issues in the markets, and we get onto the markets as opposed to the big philosophy. One of the points is leverage. We as a globe, we've taken on enormous amounts of debt in the last 30, 40 years. I mean, it's astounding, and make no mistake, that might be the most important thing we're up against in the global economy. But it hasn't been a problem up till now. So we can come back to that. That's one massive one. What happens if it turns out that actually there is just too much debt kicking around? What are the implications for that? But the other one is, how in heaven's name did the U.S. become 70% of global markets? I mean, it's astounding. It's not, actually. It's very logical and sensible. But you just have to, from an American's point of view, we'll exclude your Canadian neighbors. You could probably throw them in there, but why in heaven's name would you look outside of the U.S.? Because it's been so successful. Your stock market has done so incredibly well. Any time in the last 10 years you said you should put money offshore, it was the wrong time. And over time, people have just come to believe that because it wasn't the case in the past, it will never be the case. Our point is, listen, don't have all your investments pointed in one direction. It's a very simple, overarching theme. Just be wary of being all pointed in one direction. Be especially worried of being all pointed in one direction if it happens to have leverage and it's something that has performed, and therefore there's a lot of other investors in it. It's a crowded trade. So we're saying just make sure you got a balance. Our view over here, it's easier to see from over here, I think, than in North America. But the truth is, I think you guys, North Americans, should just be saying, really, really challenging yourself at this point to say, listen, it's been amazing being in the States, investing in U.S. assets for the last decade. Maybe time to take a little bit off and look at what might perform in the next decade. And my concern about the U.S. isn't that it's an amazing place to make money and companies profit. It's just that everyone else thinks that at the same time. So don't be all pointed in that direction. Try and find some things that are properly differentiated to us. And this is what we can get onto. We think the opportunity is elsewhere. And one of the great advantages of not sitting in North America is you can say, really objectively, what I think is the right balance here. We think the great opportunities right now are outside the U.S., not inside the U.S.
This is exactly why, to our conversation before we started, why we've committed to getting research from European analysts and economists, because of that exact point you just made. Is it is unbiased, and you brought up an interesting point. I had a client actually send me an article. This would have been last, I think, November, from a local newspaper, and it was five of the kind of usual suspects, I call them, here, that we're all commenting about, what do you do in a 5% interest rate environment? And and of course, the thing is, everything is very product solution oriented, from sort of the mainstream, sources, but there was a little glimmer of truth in there that I've gleaned out of this article. And the one person said, he goes, the one thing we don't understand is the impact of the debt, which you just brought up. And for years, people would ask me, well, what about the debt? And I'd say, well, what about it? Because it didn't matter. But, and I'm not asking you to make predictions, because that, what is that thing about, the only thing economists agree on is what's already happened. But, I'm just kind of curious. I mean, what for the average person, what is the impact of this global leverage? Because at some point it just feels like, what is it's going up $1 trillion here in the US every 100 days or something like that. I mean, that can't, at some point, the can, you can't, there's no more road to kick the can down, right?
I think one of the great ones, one of the great points is, your points earlier on, what about the debt? It hasn't mattered, and it hasn't. And what I think back to, one of the ones that just sticks with me is, do you remember just pre-GFC, 0809, everyone said, but U.S. house prices have never fallen on a national basis, ever, ever, ever. True, they hadn't. But it was such a crowded trade that you got hammered. And that's why everyone is happy to crowd that trade, is because it never happened before. I'll give you a prediction, but I would say, just sensibly, the way to think of it is, well, how comfortable are you with this? And how many eggs do you want to have in the basket that says it has to stay that way? So, just should you not be looking for a few things that can hold up, even if this turns out to be a problem? Now, I'll give you my prediction. I think it is a problem. I think it will be a problem. I think it's going to be a headwind. I think there's lots of ways out of it. I don't think the world's going to end. I'm sure we'll sort it out. but I think it could be a headwind, whereas it was a tailwind for 40 years. I mean, 82 to 2022 really was one type of market. And I think we should all be challenging ourselves. Has the regime changed? Is there, are we in another type of market? I think one of the big ones for me is inflation. That was one of the things that tied into debt. Listen, we just, it's quite a dense book, but there's a guy called Edward Chancellor wrote this book called The Price of Time. He did a chat at the Library of Mistakes if anyone wants to look it up. He talks a lot about history, and that's what he's really interested in. Let me sum up the book. Interest rate might be the most important number in the world economy, what the interest rates are. It blends together what the opportunities are and where the investments go and everything else. Listen, we just cranked that baby to the floor and left it there for a decade. I think if Edward Chancellor is right, and if the interest rate is one of the most important numbers in the global economy to make sure the global economy stays balanced, and we just messed with it for a decade, I think we could run into real problems. So my point, our point, don't be pointed all in the same direction. Make sure you've got some things in your portfolio that can do well, even if debt turns out to be a problem. I think debt will be a problem. I think it's going to be a headwind for a while, and hopefully it's no worse than that. But what I love about what I do is that I go to bed every night and I sleep well because I don't have to worry about if there's another financial crisis. We tend to do okay in financial crises because of the way we think about risk and because we start thinking about the problems before they happen. Don't try and predict when they happen. Just try and be well positioned for if they happen.
Like I said, you're like an alter ego because everything you're saying is exactly what we've taken. You're at the portfolio management level, and we're here, at the client relationship level. But it's the same thing. We call it structural diversification, and the whole idea of that's why we introduced alternatives. That's why we brought in commodities. There's a real push towards just hanging on to that 60-40. Because it's worked so well. What recency bias is what you were talking about earlier, and
when was the last time you lost money in the U.S. on a 60-40 portfolio up until 2022? 2022 was a bloodbath. What happens when that happens again? Diversification, you have to start thinking beyond what's traditionally worked.
You're right, and that gets to this idea when you say things not all pointing in the same direction. Diversification. Everybody's heard that word. We've drilled down to explain it. That means that, we're going to be apologizing for something in your portfolio because it's not all supposed to move the same direction, right?
You should be happy for that. You should be happy that it's not all pointing in the same direction.
We went back and looked at some clients who had, again, that's the challenge, I suppose. Maybe I'd be curious to ask you who you sort of report to, if it's investors or institutional people, if that's not going over a line, because I don't want to breach confidentiality. But for us, we have clients who, we preach risk management all the time, particularly for retirees, because the math of it is you have that 2022 and you're in your safe 60-40 portfolio. There are people who are still not back to where they were after the recovery of 2023, right? And that's the thing that's hard for people to grasp because, you just think, well, it goes up and it goes down. But the math of it is, doesn't work that way. And then, of course, if you're pulling money out on top of it, then you've compounded a problem that you can't dig yourself out of. And so, no, it's just refreshing to hear, your perspective because, again, you're reaffirming a lot of what we've been trying to communicate. So that's a question. Yeah, if I can ask you, kind of who are the people knocking at your door or ringing your phone to kind of find out what's going on from time to time?
We've got a combination between institutions and people like you who are managing money on behalf of the wealth managers on behalf of the end client. And we've got the end clients as well. And the clients that we like, or the clients that get on well with us, and we all understand, are the ones that understand that point of you don't want everything pointed in the same direction. There's maybe a couple of examples of the client thinking. Client one came in and said, listen, we've got global growth. I've got a UK-based client. UK growth, we've got plenty of that. I've got this great little UK value manager. They run small caps here in the UK, just down the street from us here in Edinburgh, and great guys, and they've been doing it for ages, and they're very good. Small cap only, and he's saying, I'm missing a piece there. I'm missing global value. I don't want these, for me to feel like it's not all pointing in the same direction. I need that piece. I want you to do that. And he came in, and there was a couple of tough years. We went sideways. The rest of the market's going up, and he was saying, "Well, you guys aren't making money. Everyone else is making money. Are you guys idiots?" And we sat down for a good couple of hours. And at the end of it, he said, "You know what? I hired you to do something. You're doing it. The fact that it hasn't performed yet doesn't mean that you're doing it wrong. It just means it's not your time." And balancing those 4 bits in the portfolio, understand that things can change, in your time. The other client that I thought was interesting was he's basically saying, listen, the world is insane. There's no way we can make this much money. There's no way the government can run everything. I just don't believe governments are good at running everything, and they're trying. You guys look about as well positioned as we possibly can get, that if this thing comes, if they're real rocky, if the world changes, you guys look as well positioned as you possibly can. And that's the type of, the people that he's made the connection. He made the connection between, listen, if it's weird and it's different to the past, back to my 2008-9, national U.S. house prices had never gone down before. You had to have the vision or imagination to believe that just because it hasn't happened doesn't mean it's not going to happen. And so I think that's a real challenge right now, is what's performed really, really strongly in the last little while, including, say, 4 decades, it might just be changing. And that's the real challenge for you and for all your clients. We all need to challenge ourselves on this, is what happens if this does change a little bit? Let's make sure we've got some different mentality in that. And so, those are the types of clients. The clients that understand that what they actually want, even if it doesn't perform right when they want it to, if you continue to do what you say you're going to do, and you think that it still works, listen, if it doesn't work and you just got to throw it out, but if you think that they're continuing to do, sometimes that just makes you better positioned than worse off.
There's a level of integrity in all that. This work is, I'm sure it's people and it's relationships. And I think that's where staying small really magnifies that awareness for sure. But yeah, there's like you said about sleeping at night. I remember I went through, I got into this industry in 92, and then, that was kind of a recession going on here. Then we had the bond market 94, the bond market blow up, whatever. And then we got into the tech thing, the dot-com era, and then of course, great financial crisis. And then, but I remember I was a hard one. 08, 09. I was kind of like you mentioned in the beginning. I felt like if I get through this, I'm gold. I'm gold, and we did. But it was a stressful period of time. That was just a very difficult period of time to guide clients through. This time around, with all the insanity of the world that we live in, when you get into all the geopolitics and stuff, I'm like you. I just feel like we've opened our mind to new ideas and new approaches that I wouldn't have looked at. I had a guy, just a real quick story, but reached out that's a wholesaler for a very nuanced fund families. They're small. They don't get a lot of run. You'll never see them at these conferences we go to. And they're very, a lot of QE stuff, or not QE, but quantitative, QA stuff. And the guy reached out to me, I think in 2017, and my response in the email was, unsubscribe. Because I didn't need it. There's like, back to the whole thing. This is working. And yet he had the kind of foresight to reach out again about 3 years ago. And we've implemented a lot of those types of approaches, and it's been really, really beneficial. And so the point is, as to what you said, is being willing to adapt and being willing to really just allow for the fact that, the next 20 years aren't going to look like the last 40. And so there's a peace of mind component, because I feel like with the limited quiver, that we have of all the arrows we could use, we're doing everything we can for people. And I think there's peace. So I appreciate what you said. So Maybe we can drill down a little bit without getting into proprietary, intellectual property stuff. But I'm just kind of curious, when you're, because again, with the whole globe as your potential pool of options, does your approach differentiate from one country to the next? I mean, I'm guessing there's probably some constants in there, but I'm thinking then there's these intangibles, which is where the experience comes in. Is that a fair way to put it?
What we look for is pretty universal. Like, there's a couple of things. We think rule of law really matters. We prefer not to invest where you may not be able to get your money back. Now, with the government doing what the governments are doing all the way around the world now, the rule of law is it's not an absolute. It never has been. I'm referring to what we're doing with the Russian assets. That's a big deal. Make no mistake about it. The Russians, what they're doing in Ukraine is deplorable. But the step of breaking their international property rights is a very, very big deal. We didn't do that with Napoleon. Put that in context. Now it's different, and I'm not going to make a judgment on whether they should. Legal judgment is whether they should or they shouldn't. But we are undermining legal law, so you just have to be very careful what you own. That's a big one for us. Other than that, the reason why we actually like hunting in the whole world is because we think what we look for is pretty rare. We want the absolute best company in the world we can ever buy, but we're going to buy them only at rock bottom prices. That right there that's a challenge. Every efficient market hypothesis person is going to tell you it's impossible. It's not impossible, it's improbable and rare, but it does happen. And so we really, really like that. We love being able to hunt anywhere in the world because it gives us the biggest opportunity set to find exactly what we like. And just to maybe I'll give a small pitch for the non-US investments. There's lots of good investments we have in the US as well. About 20% of the portfolio. We have 80% outside, and the ones that are and actually just to put it in context, about half of our investment in the North America is gold miners. So we're not traditional here. We still think that's a very interesting area of the market. We can come back to that. But to give you an example, the opportunities you can find in some other places. We own this little company. It's a lovely little company. They manufacture shoes. They make little strappy, high-heeled shoes. They make high-end designer shoes, especially like sneaker style, but at the very high end. The ones that you go into the fashion shop and you pay $1,000 for a pair of sneakers, they make those. It's not my style, but that's fine. That stock had cash on the balance sheet, was growing at the time, and was dividend yield and covered dividend yield, i.e. the earnings were higher at 12%. You get a 12% yield every year, dividend yield, and the company was growing, and it was on 8 times earnings, and it had no debt on the balance sheet. Why? Like, what happened? And we were sitting there, going, we obviously missing something here. Why does this happen? About 6 months ago, the market started figuring it out, and the share price doubles. So that opportunity where we're saying, listen, this is a great company. They're making better margins than they made. They're doing really, really well. No leverage problems, so on and so forth. Why does the market not care? 18 months, the market didn't care, and then it moves up. There's a company we own in Korea. There's more cash on the balance sheet than there is the whole value of the company. If you bought the whole company, I always say this to people, imagine buying a house, walking through the door, and right beside the door is a briefcase, and it's filled with cash, and you paid $1 million for the house, and there's $1 million in cash. You get to keep the house, and you got that cash. Now, the one, that is the equivalent of what we just found in Korea. It's on 4 times earnings. And it's a very good company. There are little opportunities out there that exist like that. But you have to be willing to look. You have to be willing to think outside of the box. There's always some catch. Often the earnings fell for a couple of years, and everyone said, "Oh, earnings are falling. We hate that company. Let's ignore it." Then when the earnings recover, everyone's still, they've already gone on to something more exciting. So, being able to find those types of opportunities, we're just finding many more of those in Europe and in Asia than we are in the US. And so being willing to go and look at those specific ones, wherever they are, make sure we align to the risks that we see and buy the highest quality. All the companies we buy are really good at what they do. If we don't get that, but we can get it at really, really bargain prices, that's where you can get into the situation of how you sleep at night. You know, our companies, almost none of them have any debt. I mean, most of them have stacks of cash on the balance sheet. They're all profitable. They all pay dividends. Dividends we think is really, really useful because it shows the management are willing to share. And the problem with buybacks, which again is one of our slight problems with the US, is that everyone's been buying back the shares. The problem with buybacks is you tend to buy the most when the share price is the highest. Then the share price collapses at some point for many companies. They'll all suspend the buyback at the bottom. What we like about the dividend is, you know, pay it up there, it comes right back down again. They tend to just keep paying as much as they can. That's just the mentality of these businesses. Those are the types of tricks that, you know, the tricks of the trade or qualities that we can see in our companies that make us really think, listen, this thing's already been through a really tough time. Even if it's a tough time again, they've already battle hardened. They've got rid of all the fat. They're recovering. Their competitors have all gone out of business. That sort of thing. That's the type of thing that we're finding all the way around the world and lets us sleep well at night.
So back to the shoe example. I mean, how long? Because there has to be an element. And you mentioned this earlier, but there had to be there's an element of patience in this, right? Again, I'm not trying to overstep any lines here, but I'm curious. I mean, have there been situations where you guys have made an investment, you felt really good about it, where you had to sit on it for a few years before the fruits?
All the time.
Okay.
That one we owned for 2.5 years before it started to move. 3 years before it started to move. You know, we owned it for 2.5 years, 2 years. And then 18 months it went sideways, you know, and we're saying, listen, you know, they're putting the dividend back up, it's growing again. No, we often are accused of moving early, but we think that's fine. So long as, especially you're paying dividend. I mean, we were getting paid, at worst, we were getting paid there about a, 7-8% dividend. And at the bottom, it hit 12% and then sat there for a while as I put the dividend up and the share price was down. We definitely can sit on things for a while. So long as we believe they're still running their business well, so long as we believe that the fundamentals of the business haven't collapsed. I mean, sometimes you just, the Chinese have been known, like you're seeing in solar cells, you're seeing in EVs. They're terrible to compete against at times. They can, just flood the market for long, long periods of time. It destroys the economies of the market. That happens, so you have to be aware. But no, we're happy to hold so long as we're convinced that in the long term, these good businesses, you make the big steps up. That makes it all worthwhile in the end. I would love to say that everything we bought moved the next day. It doesn't work that way. We often hold things for 4 or 5 years. And so long, what's lovely, actually, we don't mind, if we're making 5% in dividend often, 5% dividend, and just holding along the way, but the company is slowly growing, those are absolutely fine. What's quite nice is when, and another one just recently came out with it. It's been through a really pretty tough time, and suddenly it said actually, things aren't as bad as we said. The earnings are going to come in okay, up 30%, and 2 or 3 months later they came out with a positive profit warning. The share price was up another 30%. They said profits are going to double. The whole thing was on 8 times earnings, and they're saying profits are going to double. So, already got a company that's up 60% in 4 or 5 months, and it's still, on 8 times earnings, and the profits look like they might double. You say, we're happy to wait for those. When they come right, you can, that really can work well for you.
Okay, so here's a question. Because I'm listening to this, I'm thinking, and you're a smart guy. I'm not doubting any of that, but I'm always of this mindset, and maybe this is the efficient market hypothesis, whatever, that modern portfolio theory thing, where there's, it's all everything's reflected, but clearly you're able to find, diamonds in the rough, so to speak.
I'll give you a very clear why. I'll tell you how clever I am. Not very, because for about 5 years, from 2016 we had a really good year. End of 21 we had a really good time. But for about 5 years, we went sideways. I mean, we didn't really make any money. We went sideways. Everyone else in the world, especially if you're invested in Mag 7, US and technology, were making out like bandits. And so everyone's saying, you guys, you're not very clever here. And that actually is part of the reason why and then we had a great 2022. Like we made more money in the first 4 months of 2022. In absolute terms, we made more money in 2022 than almost any other year we have in the 17 years we've been doing this. We made money in a year where the markets were getting hammered. The first 6 months especially, that's when you say, okay, actually, it's because we suffered for 5 years of pain. It's because our clients were questioning us over 5 years and saying, you guys are chumps, we've got to get out of this. No one else is coming in and doing it. It leaves the opportunities to be quite large. So, there's quite a clear reason. We're super excited about Stella, is the little company in Hong Kong that makes the strappy shoes. We're super excited about it, but we can totally see why that existed. It had shrinking earnings for a while, and no one's interested. It's listed in Hong Kong. Goodness, don't go anywhere near Hong Kong. You can see the reasons why that happened. But equally, like we were saying earlier on with the debt point, it's been one of those types of market where so many people are pointing in the same direction. And again, back to, why do you talk to the Europeans? Why do you talk to other people outside North America? Is because it's been such a bull market in North America. It's really hard for North Americans to tell you not to keep going. For those of us who sit outside it and look at it and just say, well, absolutely, have a lot of money in the States, but not 70%, max 50, because you want, if you want the real opportunities to get something really different, go looking somewhere else, because that is, it's in our opinion, it's a crowded trade, so it just carries its own risk.
You can't do what you do working in a situation where you're reporting to somebody about how you're comparing to some benchmark. That and this is, I have just a small example, and I'm not, at the level you are, company level, but certainly investment level. And there's a sector, I don't know if you're familiar at all with the midstream space in the oil production. Okay. So this was a sector I got involved with back in, I think it was 2014, probably the worst time. Okay. And, just what I know of what went on over here in the U.S. with one particular portfolio that we've dealt with. I mean, it got beat up for a bunch of reasons. The partnership structures had to, too much money going into the ground, then all this environmental stuff, consolidation, dividend. I mean, it was brutal. And yet, the income kept people in. Even though it dropped a couple times, it was still better than anything else. But now, we're in the fourth year of what appears to be double-digit returns with clean balance sheets, buying back stock, can't put any money into the ground because of all these restrictions. And, it's kind of that same idea of it was having to explain why this is in a person's portfolio when everything else literally is going up. But now you get this balancing effect as time has gone on, as other things, particularly in 2022, because that was an area that actually did pretty well, and so I get the thinking, and again, that's just, that talks about, like, I keep going back to integrity, because there's a level of conviction, when you're being true to yourself and doing what you think is right, then the temptation to waver, you don't go there. And then that's just like a universal, like a spiritual principle in my mind is, if you're doing what's right and you stick with it, eventually the payday is going to come. And, I don't know. It's just nice to hear.
Especially as when it's been painful. I think you got to understand that this is it's such a rational game. We all, we love to stick numbers in spreadsheets and analyze them and stuff like that. But at the end of the day, having someone yell at you because you look like an idiot, it has an effect on you. And so you say, it's just not worth the pain, I'll sell it. But especially, I think the midstream energy space is fascinating. I mean, the investment horizons that those guys are investing on, 40 years. So the capex that the assets that they have now will run for 40 years. I mean, they can stop them, but they could run for 40 years. The cycle, it got really carried away up till 2014-15. They made huge investments, and suddenly, shale comes on in the States, and there's lots of supply out there. It got absolutely hammered. But then you have this interesting situation after that. For the next 5 years, everyone said, no, well, energy is just out of the way. Well, actually, it wasn't. It was just sitting there for long periods of time. So I think it goes back to that point of, be careful of just what's happened recently. Doesn't mean what's going to happen forever. And be especially careful when you've got a situation like that. I think energy we've got a huge issue with energy. We've got to be really, really wary of saying, let's turn off the fossil fuels before we got the next stuff. Because if we do that, make no mistake about it, who's got us? It's the Russians and the Saudis and Venezuelans and Iranians are a lot of the people who they're still pumping. If North America, you guys are pumping a little bit more than we are over here, but if we vilify these people too much, the oil energy producers we think are responsible, we can end up with a situation where we still need the energy because we haven't yet been able to figure out the renewables part, and the only people who've got it are people we don't really want to be giving money to. That's the situation. But those are the types of things you got to be thinking about that long term. To get back to the debt, debt hasn't mattered for the last 40 years. In fact, if anything, you want it to be have as much debt as you possibly could piling on. We're saying be careful of that. We're saying with the energy, be really careful that we don't underinvest in something we really need. Like this is 101. Don't underinvest in something you need because then you can end up in a real squeeze. But those are the types of situations. If you think you can find those situations, those are the types of situations that really come good when things can be difficult if you get it right. And we're with you on energy. We think energy still looks very good, and we own a couple of players there. Especially because we think that actually that's been it's like a decade in the building. Stuff that takes a decade in those industries, they don't turn around on a dime. Those are oil tankers, literally, not the speedboats.
I guess the thing I would say is, do you get a chance to travel? I mean, is a lot of this just simply work off the computer and financial numbers, or do you get out and actually get to explore and check out the management and these kinds of things?
No, we tend to be sitting at home. What we've found over time is that the CEOs are great salespeople. That's what they do. That's what they get paid the big bucks for. So actually, we meet them. We meet people. A lot of people come through Edinburgh still. We meet people here. We go down to conferences. We do travel some, but it's not a key part of our process. Key part of our process is figuring out what they say they're going to do, and then track them over time and watch what they do. When you say, how long you hold stuff and just go right, a lot of the stuff we've owned for 5 years to 10 years. I mean, we've got quite a lot of the portfolio we've owned it for a decade. You get a really good feel for whether they're doing what they say if you hold it for that period of time. And it's only by being engaged at that level over that period of time you get as good a feel, we feel, as eyeballing them, because the talk is the talk, the walk is what they do over time. So we find that actually just taking a long time to make a decision and then buying it and sticking with them and engaging with them over time, and especially tracking what they do over time. So anytime we look at a company, we're often diving back 10, 15, 20 years and go, oh, that was interesting. What were they doing back 20 years ago? 20 years is a long time ago. The world has changed in 20 years, as you and I have said. But still, it gives hints and it gives indications. So we think that the most important thing is thinking in long time frames, as opposed to I'm quite convinced. My old boss Angus Tulloch, who I did the interview at Library Mistake, he was great at just getting a nose on people. I've just figured out what works much better for me is to watch over time and be patient. And that's where we play.
That's wisdom, and I think that's kind of the last question I was going to ask you. But I've been taken in by the dog and pony shows. Go out in fancy offices, office full of attractive people, and all of it.
The proof point is just how well it's gone. If you've had an amazing 7 years, if you got an arrogant person selling an amazing 7 years, it's impossible to poke holes in that. What we do is try and figure out, okay, and then equally, it's when you go and you see the stuff that's been terrible for 7 years, and you say, well, actually, you guys are really good at what you do, and every one of your competitors has left the business. This might be interesting. So you got it both ways. You just got to challenge yourself. No, it's if you've had an amazing 7 years and you're willing to be really arrogant about it, it's incredibly how hard it is to poke holes in it.
And I guess that's the last thing, but it sounds like in addition to all the research and the work, there is an element of, I guess, instinct maybe. Is that a fair way to put it? I mean, I think because some, there's this tendency for some to just, it's all the numbers, and I think getting back to people, there's the qualitative, there's the quantitative. I think something to be said for relying on just your gut. Is that a fair way to put it?
You got to. That's the thing it's what I love about stock markets and what I hate on days about stock markets and financial markets is that they are, they're run by humans and they can be irrational with the best of them. And sometimes, you just need to dig your heels in. You've got to trust your gut and you got to be able to stick with it. And so, for all the more information that is out there, there's two things that matter. One, you got to be able to interpret the information. There's way too much information for anyone to understand, including AI. And point two is you got to have the conviction to stick with your decisions. Know when to stick with them and know when to ditch them. But that's conviction. That's gut. And that takes, if students ask me, what do I think of your fund manager? What do you need? You need good analysis skills. You need to have this and that. But you've got to be able to stick with your conviction. And that's what makes it hard. And that's what makes it rewarding. And that's why it works, is because a lot of people don't do it. A lot of people say, I kind of like what's going on over there. It looks shiny and sexy. I'll go over there. That's what makes the opportunity. Why you can find the Stellas and that little South Korean one. Get the French one next time. But it's because it hurt for a while. But that's what we like. We know that means that we got a chance of having a good one.
This is an interview that every one of my clients is going to have to listen to because it's just, there's this long-term investing, and I think that gets misrepresented, into the idea of doing the same thing, over and over again. But it's much more nuanced in that, and I think that's you've done a really great job of explaining that, and I appreciate it, Charles. I have to say, it's just, I'm just grateful there's people like you in this work because, it's you obviously enjoy what you're doing. You feel a passion for it. And that's how I feel. I like what we do. I like the fact we've got niche-y things that are different, that separate us, but also more importantly, represent a bit of a leap of faith, that makes sense. And, otherwise, what are we left with? Just collecting fees and, trying to hang on to clients. I mean, that's just boring.
History is never the same, but this is a strange time. There has been, huge amounts of money made and money lost, and there's huge changes, pandemic and so on and so forth. I quite like the expression, not pointing all in the same direction. It's very hard. How you interpret that is what makes it difficult. But the point is, just because, it's bond and it's equities, that's not pointing in the same direction, is it? Well, it turns out it was in the U.S. in 2022. So, I think you've got to be imaginative at this stage to find things that are fundamentally different and really challenge yourself to hold some things that you may not feel are comfortable, i.e. they're not as exciting or, on theme. Because I feel that might be really important to your portfolio, your client's portfolio, all of our portfolios. Because the world might be, there might be some problems. And so, thanks very much for your kind words, Emerson. But I think it is important that there are people out there still willing to challenge consensus. Because when consensus is gone, if it goes too far down in any direction, it's not a good thing. Passive is a great example. Listen, passive is amazing. God bless John Bogle of Vanguard. I mean, it's absolutely an amazing development. But it cannot run 100% in equities. If it runs 100% of equities, there are no more, everything stays exactly the same and the world is broken at that point. 100% broken if there's no more. So, how far, have we gone too far down the passive route? Or, therefore, should there be, do you need to have a little bit more active just because it's gone a little bit too carried away? These are the type of questions. Debt is a good thing. We all live on debt. Who didn't have a mortgage? You only figure out ways if you inherited cash or won the lottery. Everyone had a mortgage. Everyone leverages. That's fine. The government, U.S. government, every government needs to leverage. What happens if there's too much? These are the types of things you've got to be thinking outside the box on, because that could be really, really important to your wealth in the next 40 years. I think the last 40 years had headwinds that will now be tailwinds, and vice versa. We've all got to challenge ourselves on that.
Well, I tell you what, on that, I always like to end on a rising note of hope.
I'm ecstatic about the portfolio. look international.
No, listen, I appreciate the time, and I'm definitely looking forward to meeting you and Russell over there in Edinburgh. That sounds delightful.
Come for a visit.
No, I appreciate it. Listen, thanks so much for the time, and thanks for joining me on UpThinking Finance today.
Emerson Fersch is a registered representative with and securities offered through LPL Financial, member FINRA, SIPC. Advisor services offered through LPL Financial, a registered investment advisor and separate entity from Capital Investment Advisors. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The guest speakers and the companies they represent are not affiliated with or endorsed by LPL Financial or Capital Investment Advisors. Individual tax and legal matters should be discussed with your tax or legal expert. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.